Okay. We're going to talk about general journals, and a journal is a method of recording a transaction. So we have to start with a date. We have a description where we list the accounts that we're going to use. The post reference, which is the account number. We have a debit, and then we have a credit column. Depending on the type of account, a debit will increase, or a debit could decrease it, or a credit could increase, or a credit could decrease. Now, we must learn our debits and our credits before we really learn how to master the journal entry. What we're going to cover today is the actual recording of transactions. So we have a company, Make and Paper Music Company. Owner is Chris Brown. This is his chart of accounts as of July 1st, 2014. His cash account has $5,310 in it. His accounts receivable, $1,250. Supplies, $170. Prepaid insurance, office expense, accumulated depreciation. All of these accounts are considered to be assets. One, because we own them. Cash, accounts receivable, this is money that's owed to the company. Supplies are items that we use, such as paper, pencil. Prepaid insurance, the insurance payment for the entire year, paid up front. Office equipment, this could be printers, computers, what have you. Accumulated depreciation is attached to any fixed asset like office equipment, trucks, cars, anything like that, buildings. Anything that depreciates should have its own accumulated depreciation account. Also note that the assets start with a number 1. Cash is account 11. Accounts receivable is account 12. 14, 15, 17, 18, so on. So assets start with a number 1. Liabilities start with a number 2. So we have accounts payable, wages payable, unearned revenue. Equity accounts start with a 3. So we've got Chris Brown Capital, Chris Brown Drawing. Fees earned, which is revenue, starts with a number 4. And expenses generally start with a number 5. And we have all of these expenses. Some of these accounts already have amounts in them, some of them don't. We will get to the account balances shortly. One of the notes that we've been given here as far as this company is concerned is that the accounts payable, $250, is owed to the Mega Music Cafe, and the accounts receivable of $1,250 belongs to a customer named Wes Khalifa, and he owes us some serious money. Alright, so let's get to recording these transactions. Okay. The very first transaction down here, July 1st, Chris Brown made an additional investment in the Making Paper Music Company by depositing $4,000 in the bank. Well, if he's depositing $4,000 in the bank, one of the things that we need to consider is what accounts should we use when recording that particular transaction. So let's break this transaction down. What is the company receiving? The company is receiving $4,000. Why is the company receiving the $4,000? Because Chris Brown, who is the owner, is making an investment. We associate that account with capital, and obviously cash is going to go to the cash account. So to increase cash, we are going to debit the cash account. So on July 1st, what did the company receive? $4,000 cash. So I'm going to debit the cash account. I'm going to write cash here in the description line. Come down here to post reference. I'm going to put my account number as 11. The debit is $4,000, which increases the cash account. And then why did we receive this cash? Because the owner put it in, and we associate that with capital. So we're going to indent just a little bit. Write in the account capital. Put in the account number, which is 31. And we're going to credit this account for $4,000. Now, we have increased the cash account. We have increased the capital account. This is an asset. This is an equity. Assets increase with a debit. Capital increases with a credit. So when I post this $4,000 debit to the cash account, I'm going to add it to the balance. And when I post this $4,000 credit to the capital account, we're going to add to the balance. Okay, so we just journalized the transaction of Chris Brown investing $4,000 into his company by debiting cash for $4,000 and crediting capital for $4,000. Okay, so let's see how these transactions work when they are posted to their actual ledgers. And so what I'm going to do is I'm going to pull up what we consider to be the 4-column ledger, which is where each account has their own ledger. Similar to a journal page, but let's go ahead and look at the differences of the journal versus the ledger. Let me write ledger here. Okay. The journal has a date, description, post reference, which is the account number for the account, a debit, and a credit. This is where we record the actual transaction in the journal. We post the individual lines of the journal entry over to what we consider to be the ledgers. So cash has its own ledger, capital is going to have its own ledger, rent expense will have its own ledger. Every account has its own ledger. And at the beginning of this problem, we were told that cash started with a balance of $5,310. So we're going to come over here, and on the date, I'm just going to put July 1. This is the balance. And I'm going to come all the way over here to the debit. And I'm going to put 5,310 because I am posting the balance that we were given as the beginning balance. Why did I put it in the debit column? Well, notice that this has balance here. This is where the running balance for the accounts go. This debit and credit in the ledger is what happened up here in the journal entry. And this post reference is the page of the journal that you can find this transaction on. So this is journal page number 1. And on July 1st, on journal page number 1, we're going to do J1, journal page number 1, we debited cash for $4,000. So I'm going to transfer this debit to here. And I'm going to put $4,000. And then I'm going to simply add to the balance. Why am I adding? Because cash has a debit balance. We debited the account, which means we're going to add. And now I have $9,310 in the cash account. Okay. Notice that we only transferred what happened to the cash account to the cash ledger. Now we're going to post the capital entry to the capital ledger. Here we go. Again, all ledgers look the same. I just happened to shorten them down because I knew there was not going to be that many transactions. But notice, again, we've got the date. The date of the transaction goes here. The description, don't really need to put anything for now. Post reference, what journal page can you find it on? Debit and credit, this is what happened here. And then again, the balance. Okay, so again, this is my ledger. And on July 1st, we were given a balance of $5,000 for the Chris Brown capital account. That's the beginning balance, $5,000. So I'm going to come over here and I am going to put $5,000 in the credit column. And this is my balance. Why in the credit column? because capital has a normal credit balance. And we're always going to run the balance down this particular column. Okay? So anytime you ever come across capital and the balance is in the debit column, there's a problem. All right, so on July 1st, we credited capital for $4,000 on journal page number 1. So I'm going to write in the credit, transferring that credit from the journal to the ledger. And because this is a credit balance account, and I credited this account, I am now going to add, and I now have $9,000 in capital. Okay, now that we have recorded the transaction of Chris Brown making an additional investment of $4,000 and posting to the ledgers, we're now going to continue recording transactions. And the next transaction we need to record is on July 1st. We procured office space near a local music store and paid the rent for July of $1,800. So basically what we're saying is we found an office space and we went ahead and paid the rent for July. And so let's analyze this. What events taking place? We're paying the rent. Let's look up here at our accounts, and if I'm going to pay the rent for the office, then it stands to reason I'm going to use the office rent expense account. We went ahead and paid it, and we know that we're going to pay for that with cash. So with any transaction, we're going to debit the what? What event took place? We're paying the rent. How did we pay for that rent? We paid for it with cash. So when we're looking at the journal entry on July 1st, we're going to debit rent expense for the office. That account is $51. And the rent expense was $1,800. We're going to debit that account. Remember that expense accounts have a normal debit balance. So anytime I debit an expense account in a journal, I am adding to that account, increasing that account. And then how did I pay for the rent? I paid for it with cash. So I'm going to indent just a bit. I'm going to write cash. The account number is 11. And the credit was for $1,800. Well, why am I crediting cash? 1, because I used cash to pay for the rent expense. And 2, when I credit cash, I'm actually going to decrease this account or take away from it. So let's see how this works when we post to the ledgers. Here's the cash account ledger again. Currently, I have $9,310 in this account. But on July 1st, on journal page number 1, we credited the cash account for $1,800. So I'm transferring that credit, $1,800 credit here to a credit here. And now I'm going to subtract from the balance of $9,310. So 9,310 minus 1,800 leaves us with $7,510 in the cash account. So this is how much money we have left to work on paying bills and spending money to make money. All right, so let's recap. On July 1st, we paid the rent. We debited rent expense for $1,800. We credited cash for $1,800. So I transferred this $1,800 credit down to the ledger for cash, and then I subtracted from the balance to arrive at a new balance of $7,510. Remember, cash is an asset, has a normal debit balance. If I debit this account, I add to it. If I credit this account, we take away. Sometimes it helps when you're learning if we just do this right here over the account. So we got the cash account, It's a debit balance account, so if I debit, I'm going to add. If I credit, I'm going to subtract. Okay, so we just recorded the credit to the cash account for $1,800. So let's go ahead and record the $1,800 debit to the office rent expense account. Now, when we first got started, we were told that the office rent expense account had $750 as a balance. So the balance has been transferred as a debit. That is because expense accounts have a debit balance. And up here in the journal, we debited rent expense for $1,800. So I'm going to come down here, and on July 1st, on journal page number 1, we debited for $1,800. And now, because this is a debit balance account, and we have debited this account, we are going to add. $2,550. Okay. Alright, so the new balance is $2,550 in the office rent expense account. And again, we debited rent expense because we were paying the rent. How did we pay for it? We paid for it with cash. We debited the rent expense account, posted that $1,800 debit, added to the balance, and now we're going to move on to the next transaction. On July 1st, a 1-year insurance policy to State Farm was paid for $2,700. Notice that we use the word prepaid, a 1-year insurance policy. Sometimes the transaction will read that the premiums were paid for the year, the annual policy was paid. In this case, we're prepaying for an entire year. So instead of expensing this out, what we're looking for is a prepaid account. Anytime we prepay an expense, it becomes an asset. And in this case, we're going to use prepaid insurance. So let's analyze. What are we doing in this transaction? We're prepaying the insurance policy. So we're going to debit in prepaid insurance. And then how did we pay for it? Well, we paid for it with cash. All right, so let's record this transaction. On July 1st, we prepaid the insurance policy for the year. So we are going to debit prepaid insurance for $2,700. Prepaid insurance is account number 15. How did we pay for this transaction? We paid for it with cash. So we're going to credit cash for $2,700. And that is account number 11. All right. So let's go ahead and post these transactions to their appropriate accounts. And we'll start with the account that we debited, which is prepaid insurance. Prepaid insurance is an asset. Again, it is the prepayment of a normal expense that we would pay for month to month. In this case, we pay for the whole year. This account will be adjusted during the adjusting process. We did not have a beginning balance, so on July 1st, on journal page number 1, we debited prepaid insurance for $2,700. And now, since we didn't have a beginning balance, we now have a $2,700 balance in the prepaid insurance account. Now again, we debited prepaid insurance for $2,700, transferring that $2,700 debit down here to the prepaid insurance ledger account. And then I'm going to update the balance. This is an asset. It has a debit balance. If you debit an asset, you're going to add to it. Again, I'll put my plus and my minus up here. Debit adds to a debit. A credit takes away from a debit. All right, and then let's go ahead and post this credit to the cash account So on July 1st, journal page number 1, we credited cash for $2,700. So I'm going to transfer that credit here, call that posting. And then I'm simply going to subtract. I've got a debit balance of $7,510, and I'm crediting this account for $2,700. So I need to update the balance, and the new balance is $4,810. That's $7,510 minus the $2,700. That gives us a new debit balance of $4,810 in the cash ledger. Go ahead and look at the next set of transactions. Okay. On July 2nd, we received a check from Wes Khalifa for payment on his account, $1,250. Notice up here in our notes, it was noted that the accounts receivable balance of $1,250 was owed to us by Wes Khalifa, so he paid us, which is awesome. And so we're not going to record the receipt of this payment. So let's analyze this transaction. What are we receiving? Well, we received a check, which is basically, in essence, cash. So we received cash. Why did we receive it? Because he owed it to us. And anytime a customer owes us money, we are going to associate this with accounts receivable. So again, received a check for payment on account, $1,250. What did we receive? Cash. Why did we receive it? Because it was owed to us from a customer. So on July 2nd, I'm going to debit cash because that is what we received for $1,250. Why did we receive it? It was owed to us by a customer. Anytime a customer owes us money, we're going to associate that with accounts receivable. Accounts receivable is account number 12, and we are going to credit accounts receivable. Now, accounts receivable is an asset. It has a normal debit balance. And you're going to see that when we post this transaction, what it's going to do to the balance that is there. So let's go ahead and we're going to post this transaction to the cash account. Here I've got my cash ledger again. And on July 2nd, on journal page number 1, we debited cash for $1,250, so I'm going to transfer that here, $1,250. And then I'm going to add to the balance. And I see $7,060. Let me just verify. That would be incorrect. Alright, that is a 6. Okay, so now we have $6,060 in the cash account. We're going to come down here to the accounts receivable. Accounts receivable has a balance of $1,250. Okay, so we got a balance of $1,250, and we just credited accounts receivable here for $1,250. And so we're going to transfer this credit, post, journal page number 1. We credited accounts receivable, so I'm going to credit this account. And because I had a debit balance to begin with of $1,250, this is an asset, has a normal debit balance, and we credited for $1,250. Remember, it's a debit balance account. Debits are going to add, credits are going to subtract. So I got a $1,250 debit, $1,250 credit, and so now I have a zero balance in accounts receivable. So now I have collected on all money owed to me at this point from customers. Let's look at some more transactions. Chris Brown signed a contract with the local artist radio station to provide guest spots for the next 3 months. The contract requires Chris to provide services for 80 hours per month for $3,600 per month, and any additional hours over 80 are going to be billed to the local artist radio station for $40 per hour. So the contract says that Mr. Brown will provide 80 hours of service per month for $3,600. Any hours over 80, he gets to bill separately for $40 per hour. This doesn't require us to record a transaction because all he did was sign a contract. This does not require journal entry because a transaction actually did not happen as of yet. Okay. Let's look at some more transactions. On July 3rd, Chris Brown receives an advance payment from local artist radio station in the amount of $7,200 pertaining to the contract signed. So remember, he had a contract. The contract stated that he would provide services to the local artist radio station for 80 hours a month for $3,600. So we'll just do some little side math here. $3,600. That's $7,200. So what we're saying is that Mr. Brown received a check from the local artist radio station for $7,200, which is 2 months worth of work up front, advanced payment. Okay, what are we receiving? We're receiving cash. Why are we receiving the cash? Because it's an advance payment from a customer. If a customer pays us up front, this is considered to be unearned revenue. So, on July 3rd, what did we receive? Cash in the amount of $7,200. So what? Cash. Why did we receive that cash? Because a customer is paying us up front. And anytime we receive an advance payment from a customer, we consider this to be unearned revenue. We have done nothing to earn this money. Account number 23, and we're going to credit for $7,200. Okay. Unearned revenue. Payment up front, advance payment from a customer. We have done nothing to earn this. Unearned revenue is a liability account. We must do the work before we can consider this to be revenue. What did we receive? Cash. Why? An advance payment. That's considered to be unearned revenue. So let's post these to the ledgers. Okay. So I'm going to pull out my cash ledger. Here we go. On July 3rd, on journal page number 1, we debited cash for $7,200. So I'm going to bring that debit down here. Post. And then I'm going to add $6,060 to my $7,200. $13,260. Just going to verify. $13,260. So my new balance in the cash account is $13,260 because I received a check for $7,200. Posting it to the cash account, and now I have $13,260. So let's post this unearned revenue to the unearned revenue account. All right. Here we go. Unearned revenue did not have a balance to begin with. And unearned revenue is a liability account, so I'm just going to write liability out here. Okay. Has a normal credit balance because it is a liability. So on July 3rd, on journal page number 1, we credited unearned revenue for $7,200 because it had a zero beginning balance. we now have a $7,200 credit balance in the unearned revenue account. Journal entry, credited, post it, update the balance. This is how we analyze transactions, record the transactions, and then post them to our ledgers.